CEOs and other executives are trying to figure out if they need to recalibrate their strategies to navigate President Trump's new tariffs or if the current uncertainty will be short-lived. Joining us right now is Mark Weinberger. He's the former CEO of EY and former Assistant Treasury Secretary under President George W. Bush. Mark, you say that CEOs are still broadly supportive of the general direction of this administration's moves when it comes to policies, but you say there's a really big but that comes with that. You want to explain?
Sure, Becky. Good to see you.
You too.
Yeah, listen, the direction of travel of the administration on fairer trading system, more efficient government, lower taxes, more rational regulatory policy, certainly relative to the past administration's approaches, is something the business community has supported. But the speed of action and the methods of executing the policies have caused great concern and destruction of value. And it creates a duration risk, like having a long-term bond that is out there, and the short-term spike in interest rates causes the reduction in the value of the long-term bond. You have to meet those short-term needs of new liquidity, new changes in directions. Your margins are hit, but you just can't do it quickly. That long-term supply chain and the long-term operations of companies are difficult to readjust in this time period, which means that businesses will have to pass on in some manner the costs of these higher. If you don't want to think of a tariff as a tax, it's a higher cost on business that has to be borne by somebody, and they're figuring out how to try and do that.
You sit on the board of 4 publicly traded companies: J.P. Morgan, Johnson & Johnson, Aramco, and MetLife. What are members of directors on these boards thinking at this point? What are they asking? What do you expect to hear from managements? What can you possibly do as we wait and see how serious this is?
Yeah, Becky, we look at, what you could control in this environment. And what you need to do is you need to increase cash for the uncertainty. You need to slow down your decision making and understand the variables that are going into what a long-term investment would cost and how to unwind it, so your scenario planning expands. Some investments being paused. You can cut back on CapEx. You're reevaluating your supply chains, but you can't change quickly. Clearly, we're looking at J&J just announced a massive new investment in the United States, $55 billion over the next 4 years, above what they were doing. So lots of that, but really also, Becky, talking to our overseas partners, there's contracts that are being canceled left and right because if there is an alternative to a U.S. company right now that can officially provide a service or a product, those foreign counterparties are looking for alternatives because of the scenario of dealing with the United States and the uncertainty here. So remember, most companies, or at least the largest companies, more than 50% of their revenues comes from overseas, and that's still a very important market for us. And we don't know where that retaliation is going to be. The last point would be we're trying to just convey to the administration factually what will happen with these higher costs and what it will mean to us and how we're going to have to change our behavior, so it doesn't become an ideological issue. Factually, they understand what the implications of these are.
Mark, the jobs report that we got last week was actually a pretty good number. It was a month ago, so it's backward looking. Are the companies that you know of, are they stopping or freezing or slowing down on their hiring plans? Is this going to show up in the jobs market?
Good question. I think it really depends on the company, but I would say absolutely. You're looking at all your costs and trying to make sure that going into this really uncertain and turbulent environment where we're going to see slower growth and we're going to see higher costs, you can't just keep adding costs, and that will happen. The earnings reports, Becky, as you well know, for the first quarter are backward looking, so they're going to look pretty good, I think. The economy is still strong. Really haven't seen the reduction in job growth or even consumer confidence up to this point. We're now just starting to see a tip in both business and consumer confidence. But the guidance for the next quarter is going to be hard.
Yeah, that's what will the guidance tell us anything, or is it basically going to be like we just don't have any clarity?
Yeah, the guidance is going to have to be more general. The guidance is going to have to be dependent on externalities that businesses can't control, and I think analysts are going to have to understand that. So directionally, I think they're going to have to talk about what steps are you taking as a company to adjust to the current policies and where you expect them to go. What are you slowing down? I mean, in the big financial institutions, the M&A and the products are changing that we thought would be coming to market, and the assumptions we're making about the unemployment rate, the assumptions we're making about the growth rate are changing. That will affect outlook. But I don't think you're going to see a lot of prediction of specific earnings per share and revenue guidance because it's going to be very hard to do that.